Sir, please start.
Okay. Good afternoon to all of you students, and I welcome you. So far, your paper 2 is concerned, and we will be doing final accounts. Now, as you know, after the preparation of a trial balance, the next level of work in accounting is called final accounts. And that level is also called final accounts level. Now, if we want to prepare the final accounts, then it involves number one, preparation of a trading account. So all the expenses which are direct and incomes which are direct are taken into this trading account. Number two, preparation of a profit and loss account, which takes into account incomes which are indirect and expenses which are also indirect in nature. And finally, preparation of a balance sheet. Now, trading account is prepared to know the gross profit or overall profit, and it may show if there is no gross profit, then it is a gross loss. Profit and loss account discloses net profit or clear profit of the business. The balance sheet shows the financial position of the business on a given date, and generally on the last date of the accounting period. So, in short, final accounts are to be prepared by preparing a trading account, by preparing a profit and loss account, and finally, by preparing a balance sheet. Now, let us come to trading account. The main objective of preparing the trading account is to ascertain gross profit or gross loss of a business during an accounting period. And this accounting period is usually a year. The concept which is actually been coming from the very perception of accounting cycle. In accounting parlance, gross profit means overall profit. And to be specific, gross profit is the difference between sale proceeds of a particular period and the cost of the goods actually sold. Since gross profit means overall profit, no deduction of any short is made, that is, general, administrative, or selling and distribution expenses. Gross profit is said to be made when the sale proceeds exceeds the cost of goods sold. Conversely, when sale proceeds are less than the cost of the goods sold, then there'll be a gross loss. So that is the gist of the trading account, the main perception. Now, trading account items we are going to consider one by one. That is, if you want to prepare the trading accounts, being a ledger, having two sides, debit and credit, and trading account items in terms of debit side, we are having number one, opening stock. In case of a merchandising business, The opening stock consists of different types of finished goods. In case of a manufacturing concern, opening stock consists of raw materials, work in progress, and finished goods. Now, what is work in progress? That is called partly finished goods, which contains materials, labor, and overheads which are not 100% completed. And finished goods means the work of material, labor engaged, and overheads incurred, that is 100%. Where a separate manufacturing account is prepared, opening stock consists of only finished goods. In case of a newly set up business, there will be no opening stock at the beginning of the first year. The amount of the opening stock is available in the trial balance. Now, the next item is debit item is number two, purchases. The balance of the purchase account as appeared in the trial balance shows the total purchases made during the accounting period, which includes both cash and credit purchases. So, purchase may be cash as well as on credit basis. So that's why the balance of the purchase account as appeared in the trial balance shows the total purchases made during the accounting period, which includes both cash and credit purchases. In respect of purchases, there are certain important points which are to be taken into consideration. Number one, purchase of capital asset is expenditures which are actually being incurred once in the form of capital expenditure. So, purchase of capital asset should not be added with the purchases. If it is already included in purchases, then it should be deducted therefrom. And second point in relation to purchases is that if goods purchased for personal use and added with the purchases, it should be excluded. This type of purchases should be treated as drawings, and we are required to pass a journal entry in order to adjust the same, that is drawings account debit to purchases account. Now we are coming to point number three. If some of the goods purchased are still in transit at the year end, it is better to debit stock in transit account and credit cash or suppliers account. So mind this, if some of the goods purchased are still in transit at the year end, it is better to debit stock in transit account and credit cash or suppliers account. Then we are coming to point number four with reference to purchases. If the amount of purchases includes goods received on consignment. Now, let me tell you what is the meaning of consignment. You see, an organization, if the organization wants to sell, say, India wise, so it is not feasible for the organization to set up businesses and to have an office in all the states and union territory of India. It is not feasible. So, in order to sell the goods on nationwide, the organization may go through the process of consignment where there will be two parties One is called consignor, and the other one is called consignee, whereby the consignor, the organization, will be sending the goods to their agent who will act on behalf of the organization situated in different places of India against a commission, and commission may be of different types. There is ordinary commission, tail creditor commission, usually given when consignee is going to undertake the risk of credit sales, and special commission also. So, in a nutshell, that is the concept of consignment. Or on approval, there may be a process which is called goods on approval. So, on that basis, goods are to be sold by the organization. Okay. So, if the amount of purchases includes goods received on consignment or on approval or on hire purchase, this should be excluded from purchases. So, the idea is you have to calculate the purchases with reference to that particular business, and if the purchases includes goods received on consignment or sale on approval or on hire purchase basis, they should be excluded from purchases. Now, what is hire purchase? Hire purchase is nothing but where there will be agreement between the seller and the buyer, whereby the buyer has to pay certain amount as down payment, and other total amount after deducting the down payment will be paid by the buyer on certain installments, and until and unless the last installment is to be paid, the possession of the goods or ownership of the goods will not be passed from the seller to the buyer. That is called hire purchase. Now we are coming to fifth item. Cost of goods sent on consignment must be deducted from the purchases in case of a trading concern. Now, the third item we are coming, that is purchases returns. When goods are returned to the supplier for some reasons, in the books of account, supplier is debited and purchase returns or return outwards is credited. So, in the trial balance, it appears in the credit side. Remember, purchase accounts always having a debit balance and purchase return always having a credit balance. There are two ways of showing the purchases returns in the trading account. It may be shown by way of deduction from purchases in the trading account, but as an alternative way to show the purchase returns in the credit side of the trading account. Usually, we deduct purchase return from purchases, and the same is actually being shown in the debit side of the trading account. Alternatively, by taking into consideration the entire purchase in the debit side, we may credit the purchase return by crediting the trading account. Next, we are coming to direct expenses. Direct or direct expenses are shown separately in the trading account. Direct expenses are those expenses which are directly attributable to the purchase of goods or to bring the goods in sellable condition. So, some examples of direct expenses may include number one, freight and insurance. Freight and insurance paid in connection with acquiring goods or making them sellable is debited to trading account. Okay. Freight and insurance paid in connection with the sale of goods is charged to profit and loss account. So mind this, because students they are actually making mistakes while preparing the trading and PL account, that they may wrongly consider an amount which is related to freight and insurance. If it is related to purchase, then definitely it's to be debited in the trading account. And if it is related to sales, then it should be charged to profit and loss account. Now, freight and insurance paid for acquisition of fixed assets must be capitalized. So the meaning is that if the freight and insurance which is actually being paid at the time of acquisition of fixed assets, then it should be added to the cost of that fixed assets. Okay, that is called uh, capitalization. So freight and insurance paid for acquisition of fixed assets must be capitalized. Now we are going to have the next item, that is carriage inwards. Carriage paid for bringing the goods to the godown is treated as carriage inwards and it is debited to trading account. Next, we are coming to wages. Now, wages incurred in a business is direct. When it is incurred on manufacturing or merchandise or on making it sellable, other wages are indirect wages. Only direct wages are debited to the trading account. Other wages are debited to the profit and loss account. If it is not mentioned whether wages are direct or indirect, it should be assumed that direct and should appear in the trading account. Now, here I am just going to mention one important trick. What is that? Sometimes you see it is given wages and salaries. Now, if it is given wages and salaries, then the same should be debited to the trading account. But if it is given salaries and wages, then we have to take into account it is indirect and its same should be debited to the profit and loss account. So that is all about your wages. So based upon the direct or indirect, you have to treat it accordingly. Now, there is a concept, although somewhere it is abolished, octroi. When goods are purchased within municipality limits, generally octroi duty has to be paid. And if it is actually being paid or to be paid, whatever it may be, it is debited to the trading account. Then fuel, power, lighting and heating expenses. Fuel and power expenses are incurred for running the machines. These are considered as direct expenses since directly related with the production and debited to trading account. Lighting and heating expense of factory is also charged to trading account, but lighting expenses of administrative office or sales office are charged to profit and loss account. Then we are coming to next item, that is called packing charges. There are certain types of goods which cannot be sold without a container or proper packing. These form a part of the finished product. One example is ink, which cannot be sold without a bottle. These types of packing charges are debited to trading account. But if the goods are packed for their safety, for their safe dispatch to customers, that is packing meant for transportation or fancy packing meant for advertisement, then it will appear in the profit and loss account. Now we are coming to the last item. So for the debit is concerned, that is duty on purchases. Now, any duty paid in connection with the purchase of goods is debited to trading account. Okay, so remember all these items that I have discussed, which will appear in the debit side of the trading account. Now we are coming to the credit side and let us see what are the items that will generally come in the trading account. Remember, paper 2 is the foundation. So if your foundation is strong, then automatically you are in a position to come with flying colors so far your next higher examinations are concerned, that is intermediate and final. So you have to have your basic perception and concepts. Now we're discussing credit items that will appear in the credit side of the trading account. Number one, sales. The balance of the sales account, as it appears in the trial balance, shows the total sales made during the accounting period, which includes both cash and credit sales. Now, with reference to or respect to sales, the following points must be noted. That is, number one, if the goods are sold but yet to be dispatched, it should not be included in sales. But the closing stock will be increased by the cost of such goods if the property in goods has not yet been transferred. So mind this, if the goods are sold but yet to be dispatched, it should not be included in the sales. But the closing stock will be increased by the cost of such goods if the property in goods has not yet been transferred. Then, if sale of fixed assets is included in sales, it should be deducted from sales. Next, goods sold on approval or on consignment or on hire purchase should be recorded separately. If these are included in sales, this should be deducted. Now we are coming to number two, that is sales returns. When goods are returned by the buyers for some reasons in the books of account, returns inward account or sales returns account is debited and buyer is credited. In the trial balance, it is appearing in the debit side. There are two ways of showing sales returns in the trading account. It may be shown by a deduction from sales in the trading account or as an alternative way to show the sales return in the debit side of the trading account. So first one is generally is more acceptable. Now we are coming to number three, that is closing stock. The last item in the credit side of the trading account is the closing stock, which is the value of goods which remain unsold at the end of the period. In case of a merchandising business, the closing stock consists of different types of finished goods. In case of a manufacturing concern, closing stock consists of raw materials, work in progress, and finished goods. As I have told, work in progress also may mean partly finished goods or semi-finished goods. Where a separate manufacturing account is prepared, closing stock consists of only finished goods. Then closing stock is an item which is not generally available in the trial balance. So this is very important. Please try to understand closing stock is an item which is not generally available in the trial balance. However, if the closing stock is adjusted against the purchases, it will appear in the trial balance. When closing stock is shown in the trial balance, it will not be included in the trading account. It is to be shown in the balance sheet. So please, dear students, please mind this. This is very, very important. And again, I repeat, closing stock is an item which is not generally available in the trial balance. However, if the closing stock is adjusted against the purchases, it will appear in the trial balance. When closing stock is shown in the trial balance, it will not be included in the trading account. Then it is to be shown in the balance sheet. Now remember, there is a norm that I have already discussed earlier. In this connection, it should be noted that closing stock is valued at cost or net realizable value, whichever is lower. So net realizable value means sales minus selling expenses, if any. So closing stock is valued at cost or net realizable value, NRV, whichever is lower. Therefore, in the trading account and or in the balance sheet, we'll include it at cost price or net realizable value, whichever is lower. So that includes the items which are to be considered in the credit side of the trading account. Then comes balancing of trading account. After recording the various items as I have discussed in respective sides of the trading account, the balance is calculated to ascertain gross profit or gross loss. If the total of credit side is more than that of the debit side, the excess represents gross profit. Conversely, if the total of debit side is more than that of the credit side, the excess represents gross loss. Gross profit is transferred to the credit side of the profit and loss account, and gross loss is transferred to the debit side of the profit and loss account. Okay, so that is all about your balancing of trading account. Now we are going to discuss about closing entries. Now, for the items of debit side, we are going to have the closing entry like trading account debit to opening stock, to purchase account net, that is purchase less returns, to direct expenses account. For the items of credit side, we are having sales account net debit, closing stock account debit to trading account. For gross profit, we are having trading account debit to profit and loss account. For gross loss, the entry will be reversed. That is profit and loss account debit to trading account. So that is all about your trading account and closing entries. Now we are having profit and loss account. After preparing trading account, the next step is to prepare profit and loss account with a view to ascertain net profit or net loss during an accounting period. So what I have said, gross profit is called overall profit. But when I'll be taking into consideration the net profit or net loss, whatever it may be, then definitely we are going to prepare the profit and loss account once the trading account is prepared. So we may say that after preparing trading account, the next step is to prepare profit and loss account with a view to ascertain net profit or net loss during an accounting period. Now, the profit and loss account can be defined as a report that summarizes the revenues and expenses of an accounting period to reflect the changes in various critical areas of firm's operations. Now, I have already pointed out that earlier, the balance of the trading account, gross profit or gross loss, is transferred to the profit and loss account, which is the starting point of the preparation of the profit and loss account. Okay. So for this reason, trading account is treated as a subsection of the profit and loss account. Okay, so mind this. This is why trading account is treated as a subsection of the profit and loss account. Profit and loss account shows the profit or loss on ordinary activities, profit or loss on the sale of a capital asset, other abnormal losses and gains, but excludes the payment of taxation, transfer to or withdrawal from reserves or from the business and the distribution of profit. After transferring the gross profit or gross loss from the trading account to the profit and loss account, the sources of other incomes like commission or discount received are shown on the credit side of the profit and loss account. The credit side also includes the non-trading income like interest on bank deposit or securities, dividend on shares, rent of property let out, profit arising out of sale of fixed assets, etc. On the debit side, all expenses appearing in the trial balance which cannot be find a place in the trading account will appear. The debit side will also include the losses arising out of sale of assets and any abnormal losses. Okay. Now, the profit and loss account measures net income by batching revenues and expenses according to the accounting principles. So, please keep the stress on this sentence. The profit and loss account measures net income by batching revenues and expenses according to the accounting principles. Net income is the difference between total revenues and total expenses. In this connection, we must remember that all the expenses for the period are to be debited to this account, whether paid or not. If it is paid in advance or outstanding, proper adjustments are to be made. That I have discussed, I'll be discussing later. Likewise, all revenues, whether received or not, are to be credited. Revenue, if received in advance or accrued, but not received, proper adjustment is required. Now, after transferring all the nominal accounts from the trial balance to the profit and loss account, it is necessary to balance the profit and loss account. If the credit side is more than the debit side, it indicates net profit for the period. Conversely, if the debit side is more than credit side, it indicates net loss for the period. Now, we are considering the profit and loss account items. The debit side. The items that will appear in the debit side of a profit and loss account can broadly be classified as number 1, management expenses, number 2, maintenance expenses, number 3, selling and distribution expenses, number 4, financial expenses, and last but not the least, abnormal losses. Now, let us discuss one by one so far the various items are concerned. Now, first one is management expenses. These are the expenses incurred for carrying out the day-to-day administration of a business. Expenses under this head include office salaries, office rent and lighting, printing and stationery, and telegrams, telephone charges, etc. Next, we are coming to maintenance expenses. These expenses are incurred for maintaining the fixed assets of the administrative office in a good condition. They include repairs and renewals, etc. Next, we are coming to selling and distribution expenses. These expenses are incurred for promoting sales and distribution of sold goods. Example of such expenses is godown rent, carriage outwards, advertisement, and cost of after sale service, selling agents commission, etc. Now the fourth one is financial expenses. These expenses are incurred for arranging finance necessary for running the business. These include interest on loans, discount on bills, brokerage, and legal expenses for raising loan, etc. The last item is abnormal losses. These are some, there are some abnormal losses that may occur during the accounting period. All types of abnormal losses are treated as extraordinary expenses and debited to profit and loss account. Examples are stock lost by fire and not covered by insurance, loss on sale of machinery, cash defalcation by the cashier, etc. Now, at this juncture, we should know there are certain expenses that will not appear in the PL account that I am going to discuss right now. So I have written following are the expenses not to appear in the profit and loss account. Number one, domestic and household expenses of proprietor or partners. Number two, drawings in the form of cash, goods by the proprietor or partners. And third one, personal income tax and life insurance premium paid by the firm on behalf of proprietor or partners. Now, the expenses of a particular accounting period include the cost of the product sold in that accounting period, though these products were purchased or manufactured in an earlier period. The wages and salaries earned by the worker, whether paid or not, and rent, electricity, telephone expenses are to be taken into consideration, whether paid during the accounting period or not. To ascertain the amount of expenses to be debited to the profit and loss account, four types of events are needed to be considered, and the cash payment made in connection with these events, they are as under. Number one, expenses incurred and paid out in that year. If an expenditure is incurred in 1 year and also paid for in the same year, the transaction becomes simplest and least troublesome. So mind the language, if an expenditure is incurred in 1 year and also paid for in the same year, the transaction becomes simplest and least troublesome. Most of the expenses for a period are generally paid before the accounting period is over. Hence, here when the expenses are incurred and payment is made, we debit expenses account and credit cash or bank account. At the year end, the expense account cannot have any balance since closed by transferring it to the profit and loss account, by debiting profit and loss account and crediting the expense account. So we are discussing about expenses incurred and paid out in the same year. Okay, now we are coming to second type, expenses incurred but not paid out partly or fully during the current year. So there are some expenses which are incurred in the current accounting period but not paid for partly or fully by the end of the period are called outstanding expenses. So outstanding expenses include outstanding salaries, interest, rent, wages and other expenses. These must be duly accounted for because the parties who furnish goods or service have a claim against the business for the amount due to them, and these amounts therefore become the liabilities of the business at the end of the accounting period. So expenses incurred but not yet paid will be treated as a current liability of the accounting period and will be treated accordingly. Now, in fact, on the date of the final accounts, outstanding expenses, both an expense and a liability exist, without having been recorded in the books of account. For recording it, the following entry is to be passed. Expenses account will be shown in the profit and loss account. Two outstanding expenses account will appear in the liability side of the balance sheet. We are coming to third category, expenses paid for during the current year but not yet incurred, partly or fully. Sometimes it happens that some expenses are paid for during the current year but not yet incurred, partly or fully, are known as prepaid expenses. Prepaid expenses include prepaid insurance premium, rent, taxes, interest, etc. A prepaid expense is an asset and will be shown in the balance sheet. The adjusting entry to be passed, prepaid expenses account debit, to be shown as asset in the balance sheet. To expenses account, balance of this account is to be debited to PL account. Now, we are coming to the fourth category, that is expenses of the current year likely to arise in subsequent period. Sometimes an expense or a loss may arise in the future in connection with current year's business. In such a case, we make a provision of the anticipated loss and a charge is created against the profit for the current period. This provision is shown either as a liability or as a, please mind the word, contingent asset. It is not an asset, but it will be an asset. The happening of the same is dependent upon certain future events, which is uncertain. That is called contingent asset. That is, it appears in the balance sheet as a deduction from some other asset. Okay. Now, we are coming to the credit side, but before credit side, remember the best example I am going to give you. So for the expenses of the current year, likely to arise in subsequent period, the best example of this anticipated expense is provision for bad and doubtful debts. Okay, now we are coming to the credit side of the PL account. The items that appear on the credit side of the profit and loss account can broadly be classified as under. Number A, gross profit. Number B, other incomes. Number C, non-trading income. And number 4, abnormal gains. Gross profit that we have already discussed, but since it will appear in the credit side of the PL account, that's why we are discussing again. This is the balance of the trading account transferred to the profit and loss account. If the trading account shows a gross loss, it will appear on the debit side. Next, we are coming to other incomes. During the course of the business, other than income from the sale of goods, the business may have some other income of financial nature. The examples are discount or commission received. Next item is non-trading income, which has no relationship directly with purchase and sales activities. That's why it is called non-trading income. The business may have various transactions with the bank. At the end of the year, the business may earn some amount of interest, which will find a place in the profit and loss account as non-trading income. The business may have some investment outside the business in the form of shares or debentures or units. Any income received from these investments is also considered as non-trading income and are treated in the same way. Now, abnormal gains. There may be capital gains arising during the course of the year, namely profit arising out of sale of a fixed asset. The profit is shown as a separate income on the credit side of the profit and loss account. Now, in this connection, we are required to remember that all the other incomes or abnormal gains are to be credited to the profit and loss account if they arise or accrue during the period. Similarly, income received in advance is to be deducted from the income. Now, for this purpose, there are certain adjustments which are to be considered. Number one, income accrued but not received, partly or fully. Accrue means increase. Certain income such as interest on debentures, dividend on shares, accrued during the accounting period are accrued during the accounting period but are not received. Adjusting entry is required to recognize these unrecorded increases, that is, accruals in income. For recording, we are going to pass an entry, and the entry will be accrued income account debit, will be shown in the asset side of the balance sheet to income account to be credited to the profit and loss account. Now, we are coming to the second type, that is income received in advance during the current period. Income received in advance is not the revenue of the current accounting period. It will be recognized as income in the coming year. Income received in advance is treated as a liability and shown in the balance sheet. And for this purpose, the entry will be income account debit, balance to be credited to the profit and loss account, to income received in advance to be shown in the liability side of the balance sheet. So now we are going to discuss about the closing entries which are to be required for closing the various accounts with reference to profit and loss account. So the journal entries to be passed in connection with the preparation of the profit and loss account, and these are number one, for the items of debit side, profit and loss account debit to expenses, losses, etc. accounts. For gross profit, trading account debit to profit and loss account. For other income, abnormal gain, account debit to profit and loss account. Then comes balancing the profit and loss account. The balance in the profit and loss account represents the net profit or net loss. If the credit side is more than the debit side, it shows the net profit, and if the debit side shows more than the credit side, it shows net loss. When the profit and loss account shows the net profit, we pass the entry, that is profit and loss account debit, to net profit account. So this entry will be reversed in case of loss, that is net profit, net loss to profit and loss account. Okay, so that is all about your trading and PL account, and we have considered almost all the items which are to be appear in the trading and profit and loss account. Now we are coming to the balance sheet. So just a minute. Let me see. Whether I think you have understood. Just a minute. Now, someone is asking whether to solve the previous year's questions. Of course, because practice makes a person perfect. So definitely you have to practice previous year's questions also for your knowledge and increasing the level of knowledge and to pass the examination and also to uh, get good numbers. That is good marks. So for that it is necessary. Okay. Now we are coming to the balance sheet. A balance sheet is a list of assets and claims of a business at some specific point of time and is prepared from an adjusted trial balance. It shows the financial position of a business by detailing the source of funds and the utilization of these funds. A balance sheet shows the assets and liabilities grouped, properly classified and arranged in a specific manner. Now, it is already been stated that after a trial balance is prepared and adjusting entries are passed and incorporated in the trial balance, some accounts are closed by transferring to the day account, and some accounts are closed by transferring to the profit and loss account. These accounts are in the nature of expenses and revenues, with the remaining accounts lying in the trial balance, which mainly represent assets and liabilities, and adjusting accounts. A balance sheet is prepared to ascertain the financial position on a given date. So, in this connection, we must remember that one account appearing in the unadjusted trial balance has to be shown either in the trading account or in the profit and loss account or in the balance sheet. However, an adjusting account figures both in the trading and profit and loss account and in the balance sheet. For example, rupees 200 to be provided for outstanding salaries. In the profit and loss account, salaries account to be increased by rupees 200, and in the balance sheet, outstanding salaries to be shown in the liability side. Okay. Now we may say that balance sheet is statement of assets, liabilities, and capital. A balance sheet is a statement of the assets, liabilities, and capital of an organization at a particular date, which gives a true and fair view of the state of affairs of the business. Now, the financial position of a business is indicated by its assets on a given date and its liabilities, excluding capital, on that date. Remember, assets and liabilities are two independent variables, and the capital is the dependent variable because capital is the resultant of these two varying factors, assets and liabilities. Excess of assets over liabilities represents capital and is indicative of the financial soundness of the business. Now, in the context of preparing the final accounts, that is trading, profit and loss account, and balance sheet, there are certain adjustments which are required to be passed, and we will be discussing these adjustments one by one. Number one, goods distributed as free samples. This is one kind of advertisement. When goods are distributed to the prospective customers as free samples, an expense is incurred known as advertisement expense. And there is an usual deduction from the stock of goods. And the entry will be advertisement account debit to purchase account for a trader or to trading account for a manufacturer. Then at the year end, advertisement account is closed by transferring to the profit and loss account. And the required entry will be profit and loss account debit to advertisement account. Now, we are coming to second item, that is income tax. Remember, income tax is not an expense to earn revenue. Obviously so. If you are having an income and if it exceeds certain limit, I'm talking about individuals having businesses, then there will be an income tax. So income tax is not an expense to earn revenue. Therefore, while ascertaining the profit of a concern, income tax is not treated as an expense to be deducted from the profit. For a sole proprietor, income tax is payable by the owner and not by the business. Therefore, if income tax appears in the trial balance, it should be treated as drawings and should be deducted from capital. And for this, the entries to be passed is income tax account debit when paid to cash or bank account. And by the way, there will be another entry, that is drawings account debit to income tax account. Now, but for a registered partnership firm, it is payable by the business itself and not by the partners. If it generally appears as an appropriation of the net profits and the entry to be passed is profit and loss appropriation account debit to income tax account. Now, we are coming to a very sensitive concept, adjustment, that is called advance tax. Now, for a sole proprietor, advance tax is payable by the owner and not by the business. Therefore, if the advance tax appears in the trial balance, it should be treated as drawings and should be deducted from capital. The entries to be passed in this connection: number one, advance tax account debit when paid to cash or bank. Second, drawings account debit to advance tax account. Then we are coming to interest on advance tax. If any interest is received on advance tax, it is not the income of the business. It is the income of the proprietor. Therefore, if the interest on advance tax appears in the trial balance, it is shown in the credit column of the trial balance and it should be added with the capital. The following entries are required to be passed. That is, bank account debit to interest on advance tax. Second, interest on advance tax account debit to capital account. Next, we are coming to drawings made by the proprietor. Drawings made by the proprietor may be in cash or in kind. Drawings relate to the resources of the business and the capital of the owners. Drawings made in cash, in this case, the entries to be passed are drawings account debit to cash oblique bank account, and correspondingly, we have to pass another entry, that is capital account debit to drawings account. Then comes drawings made in kinds. When some of the stocks withdrawn from the business, the following entry is to be passed. Drawings account debit to purchase account, and number two, capital account debit to drawings account. If the drawings made by the owner are included in sales, we have to pass a reverse entry to cancel the original entry. And for the drawings, item number 1 and 2 that I have said, these two entries are to be passed. Next, number 7, debtors arising out of dishonor of checks or bills. When a check previously received from a debtor is dishonored, the old position of debtor and creditor is restored between the buyer and the seller respectively. Here, debtor account is debited and bank account is credited. In effect, the value of the sundry debtors is increased and the bank balance is decreased. So the value of the sundry debtors is increased and the bank balance is decreased. When a bill previously drawn on a debtor is dishonored, debtor account is debited and the person who is holding the bill is credited. Here the value of the sundry debtors is increased and one of the following that I have mentioned will be credited depending on the manner in which it has been previously dealt with. So we have to debit sundry debtors account for dishonor of bill to bills receivable account when the bill is retained, to bills for collection account when the bill is sent to bank for collection, to bank account when the bill is discounted with the banker, to endorsee account when the bill is endorsed, that is transferred to a third party. If a provision for doubtful debts is to be created, it will be on the value of the sundry debtors after making the adjustment that right now I have said. Now we are coming to another important part, that is abnormal loss of stock by accident, namely by fire. Now, please allow me 2 minutes. After 2 minutes, I'll be discussing about abnormal loss of stock by accident, that is by fire. Please allow me 2 minutes. Now we are discussing about abnormal loss of stock by accident, that is by fire. So it is a very, very important adjustment, and you have to learn it by your heart because this will be required in your intermediate level also. If a portion of the stock is lost, the value of such loss is first to be ascertained. Thereafter, abnormal loss account is to be debited and trading account is to be credited. Abnormal loss account is closed by transferring to the profit and loss account. That is, profit and loss account is to be debited and abnormal loss account is to be credited. If the loss that is we are talking about is insured against risk, insurance claim account or insurance company account is to be debited and abnormal loss account is to be credited. Till the time money is not received, insurance claim or insurance company account will find a place in the asset side of the balance sheet. When the money is received, bank account is debited and the insurance claim or the insurance company account is credited. Now, it may happen that if the goods are partially insured, the portion not covered by insurance is to be charged to profit and loss account. And for this, we are required to pass a journal entry, and the entry will be accidental loss account debit, that is the actual loss of stock, to trading or purchases account. Now, second entry, insurance claim account debit, insurance claim admitted by the insurance company or insurance company account, insurance claim admitted by the insurance company. So, profit and loss account will be debit, claim not admitted to accidental loss account. So, this is a very, very important adjustment. So far, abnormal loss of stock by accident, namely by fire. Now we are coming to another important adjustment, that is goods sent on approval. Now, let me tell you about this. When goods are sold to the customers on sale or return or an approval basis, it is not considered as sale till the time it is not approved by the customers or the expiring of a fixed period as agreed by the parties. When goods are sold initially to a customer on approval basis, we pass the entry for the sales. At the year end, if the goods are still lying with the customer, awaiting approval, then we have to pass the entries. That is number one, to cancel previous entry. That is sales account debit, sales value to Sundry Debtors account. Number two, to add the value of the closing stock. That is cost of goods lying with the customers. Then the entry will be stock with customers account debit to trading account. In the balance sheet, it will be deducted from Sundry Debtors at sale price, and the closing stock will be increased by the cost of such sales. Now we are coming to number 10 item. Goods received on approval basis. Goods may be received on approval basis from the supplier. These goods are not recorded in the books of account when these are received. Only when these goods are accepted, it is recorded as purchase. Before acceptance of these goods, supplier is the owner of these goods. Therefore, these goods are not to be included in the closing stock also. However, if these goods are recorded wrongly as purchase, we are required to pass an adjustment entry, and the entry will be suppliers or creditors account debit to purchase account. Now, from the closing stock, cost of such goods are to be eliminated if cost of such goods were taken into consideration at the time of closing stock valuation. Okay, now we are coming to number 11. Interest on loan not yet paid or fully or partly. In the trial balance, the amount of the loan appears in the credit column. The amount of interest paid appears in the debit column. If a portion of the interest is still outstanding at the year end, we have to pass a journal entry, and this is an adjustment entry that we are required to pass is interest on loan account debit to loan account. Okay. If nothing has been paid as interest, we have to find out the amount by applying the rate, the amount of the loan, and pass the entry that is interest on loan account debit to loan account. The total of unpaid interest or the total amount of unpaid interest will appear in the balance sheet as a liability. Now, we are coming to number 12, interest on capital. Sometimes it may be required to make a provision for interest on the capital contributed by the proprietor or the partners. Such interest is not a charge against profit, but an provision. And for this reason, we are required to pass two entries. The first entry is profit and loss attribution account, debit to interest on capital account. And the narration will be being interest on capital payable. And the second one is the interest on capital account debit to capital of the current account, being interest to capital transferred to capital or current account. Next, we are coming to number 13, interest on drawings. Sometimes interest on drawings may be charged to restrict the frequent drawings by the partners. Such interest increases the divisible profits. The following two entries have to be passed. Interest on drawings account debit to profit and loss attribution account, and capital or current account debit to interest on drawings account. And the narration will be being interest on drawings transferred to capital or current account. Next, we are having item number 14, that is closing stock. Closing stock appearing in the additional information will be credited in the trading account and is to be shown as a current asset in the balance sheet. Now, if closing stock is appearing in the trial balance, it is to be shown in the balance sheet only. So, considering this, Now we are going to solve the problems, uh, and let us start to solve the problems. Just have a look. Prepare a trading and profit and loss account for the year ended 31st December 2021 and a balance sheet as on date. On that date, from the following trial balance and the adjustment items. So we are provided the trial balance and we are provided with debit columns and credit column and particulars. In the examination hall, you have to first, with the help of the calculator, you have to check where the trial balance total is agreed or not. That is the first task you have to make. So it is given total 15 lakhs 14,300 and also 15 lakhs 14,300. That you have to check quickly. Then we are having opening stock, purchases and sales respectively, sales return and purchase returns, then discount received, then wages, then salaries, then carriage inwards, advertisement expenses, bills receivable and payable respectively, 12% bank loan taken on 1st November, office equipment, land and building, provision for doubtful debts, Sunday debtors and Sunday creditors, rates and taxes, office electricity expenses, telephone charges, cash at bank, printing and stationery, postage stamps, furniture, petty cash, prepaid printing, insurance premium, carriage outwards, bad debts, interest on bank loan paid, capital account, reserve for discount on creditors. Okay, now the adjustments given, number one, closing stock was valued at rupees 38,000 on 31st December 2021. Goods worth rupees 2,500 were distributed by salesmen as pre-samples, but no entry has been made for this. Depreciate furniture by 7.5% per annum and office equipment by 10% per annum. Reserve for discount on creditors to be maintained at 2%. Provision for doubtful debts to be maintained at 5% on debtors. Create a provision for discount on debtors at 2%. Commission of rupees 1,300 was earned but not yet received. Rates and taxes, rupees 800 were paid in advance. Creditors include a debt of rupees 4,000 to Mr. Nair, who is also included in the list of debtors, rupees 5,000, therefore to be set off before calculating the reserves. Now, we are preparing trading and profit and loss account for the year ended 31st December 2021. Okay. So we are taking opening stock. We are taking purchases less returns. So net purchase is recorded. We have taken wages. We have taken carriage inward. Then in the credit side, we are writing buy sales, less sales return. So net sales is accounted for. Then by advertisement. Then by closing stock. So credit is more than the debit. So in the debit side, we write to gross profit carried down 2,93,900. In the next part, We have brought forwarded the gross profit. Then credited by reserve for discount on creditors. I'll show you in note 1. Then accrued commission. Then by provision for doubtful debts, old minus new reserves. Then 2 salaries, 2 advertisement expenses, add goods distributed as free sample, 2 bank interest, add outstanding, 2 rates and taxes less paid in advance, to office electricity, to telephone charges, to printing and stationery, to postage and stamps, to insurance premium, to carriage outwards, to bad debts, to depreciation on furniture and on office equipment, to provision for discount on debtors. Now, credit is more than the debit. Then we have to write to net profit transferred to capital account. Now, in the asset side, we are going to have land and building, then office equipment less depreciation, then furniture less depreciation, then closing stock, then sundry debtors less creditors set off. You see, if you look into item number I, creditors include a debt of rupees 4,000 to Mr. Nair, who is also included in the list of debtors for rupees 5,000 and therefore to be set off before calculating the reserve. So that's why we have deducted from sundry debtors less creditors, set off 4,000, then less provision for doubtful debts, then less provision for discount on debtors, then bills receivable, cash at bank, petty cash, rates paid in advance, accrued commission, prepaid printing. And in the liability side, capital as on the beginning, add net profit, then 12% bank loan, add outstanding interest, then sundry creditors less debtors set off, less reserve for discount on creditors and bills payable. So we see that your total liability is equal to your total assets, which is 8,07,411. Now we are coming to working notes. Number 1, when reserve for discount on creditors account is maintained, any discount received is credited to this account. For creating a new reserve, the balance of reserve for discount on creditors is also taken into consideration. And reserve for discount on creditors account is shown. That is to balance BD by discount received by balance carried down. That is 2% of 36,000. And the amount that will go to the PL account, that is the balancing figure, that is 1220. So total comes to 2920. Okay. So try to understand how the trading and profit and loss account is prepared. I have already discussed in detail that in trading account, what are the items that will appear and the form of debit and credit. And then I have also discussed what are the items to be included in your profit and loss account, taking into consideration the debit and credit And going through the various adjustments, we have to deduct prepaid expenses, but we have to add outstanding liability. Similarly, we have to consider accrued income, but we have to deduct income received in advance. And of course, taking into consideration the depreciation and all other items, we have to prepare the net profit or net loss. And that is to be transferred to the capital account. Okay. Now, in the balance sheet, we have to take liability side capital, then net profit, then 12% bank loans at outstanding interest, syndicated less debtor set off, less reserve for discount on creditors and bills payable. Similarly, in the asset side, land and building, office equipment less depreciation, furniture less depreciation, clothing stock, candidates, less creditors set off, less provision for doubtful debts, less provision for discount on debtors. Then bills receivable, cash at bank, petty cash, rates paid in advance, accrued commission, prepaid printing, etc. And we'll see that your balance sheet will be tallied. And here I have prepared reserve for discount on creditors. We have brought down the opening balance. We have credited the discount received account. Then closing reserve is to be maintained on the closing balance, that is 36,000, and that is 2% on 36,000. And ultimately, the amount that should be transferred to the profit and loss account as balancing figure. Okay. Now we are coming to the next problem. The following is the trial balance of Mr. Bharat on 31st December. We are having capital, Sunday creditors, plant and machinery, office furniture fittings. Stock as on January, motor van, Sunday debtors, cash in hand, cash at bank, wages, salaries, purchases, sales. Then bills payable, bills receivable, return inwards, provision for doubtful debts, drawings, return outwards, rent, factory lighting and heating, insurance, general expenses, bad debts, and discount received and discount allowed. Debit means discount allowed and credit means discount received. The following adjustments are to be made. Stock on 31st December, 5,200. 3 months factory lighting and heating is due, but not paid rupees 30. 5% depreciation to be written off on furniture. Write-off for their bad debts, rupees 70. The provision for doubtful debts to be increased to rupees 300, and provision for discount on debtors at the rate 2% to be made. During the year, machinery was purchased for rupees 2,000, but it was debited to purchase account. You are required to make the necessary journal entries and prepare trading profit and loss and the balance sheet. So, in this case, we are required to pass the journal entries, okay, and then we are required to prepare the trading profit and loss account balance sheet. So, in the books of Bharat, to pass the journal entry, That is adjustment entries. The first entry is factory lighting and heating account debit to outstanding factory lighting and heating account. Being adjustment for outstanding factory lighting and heating. Then depreciation account debit to office furniture and fittings. That is being amount written off as depreciation on furniture at the rate 5% on 260. Then bad debts account debit to Sunday dealers account. That is bad debts written off. Then plant and machinery account debit to purchase account. Being purchase of machinery wrongly debited to purchase account, now rectified. Now profit and loss account debit to provision for bad and doubtful debts to provision for discount on debtors. Being the creation of necessary provision for bad and doubtful debts and discount on debtors. Then we have to pass the all closing entries, that is trading account debit to opening stock, to purchase account, to wages account, to factory lighting and heating account. Then sales account debit to trading account, being sales account transferred to the trading account. Then closing stock account debit to trading account, being closing stock transferred to the credit of the trading account. Then trading account debit to profit and loss account, the gross profit transferred to PL account. Then profit and loss account debit to salaries account, to rent account, to insurance account, to general expenses account, to discount account, to bad debts account, to depreciation on furniture and fittings account. That is various expenses transferred to the debit of the profit and loss account. Then discount account debit to profit and loss account, being discount receipt transferred to the credit of the PL account. And finally, profit and loss account debit to capital account, that is net profit transferred to capital account. Now we are having trading and profit and loss account for the year ended 31st December. To opening stock, then to purchases less returns, less machinery purchase wrongly taken in purchase account. That already we have passed one entry to rectify that mistake. So from purchase, the machinery purchase also is deducted. Then to wages, then to factory lighting and heating, add outstanding. Then buy sales less returns, inwards, sales return. Then closing stock. Then we have gross profit. That is credit is more than the debit. So gross profit carried down is 13,560. Then we are going to brought down gross profit. Then we are required to carry discount received. And in the debit side, we are writing two salaries, two rent, two insurance, two general expenses, two discount, then two bad, add further bad debts, to provision for doubtful debts, new minus old, to provision for discount on debtors, to depreciation on furniture. So credit is more than the debit, so that we have two net profit transferred to capital account. Now we are preparing the balance sheet. So in the asset side, we are having plant and machinery purchased wrongly entered in the purchase account after adjusting We have to increase the plant and machinery account through addition 2000, then motor van, then office furniture, less depreciation, then Sunday debtors, less further bad debts, less provision for bad debts, less provision for discount on debtors, then closing stock, then bills receivable, then cash at bank, then cash in hand. And in the liability side, we are having capital, opening balance, add net profit, this drawing, then bills payable, sundry creditors, outstanding factory lighting and heating. So by doing this, we'll find that the balance sheet total is tallied, that is 19,173. Now we are coming to our next sum. From the following figures extracted from the books of Govind, you are required to prepare a trading and profit and loss account for the year ended 31st March and the balance sheet as on that date after making the necessary adjustments. So we are having capital, we are having drawings, we are having plant and machinery, we are having freehold property, we are having opening stock, we are having wages, Sunday creditors, postage and telegrams, we are having purchases, we are having return outwards, we are having salaries, office expenses, office furniture, discounts, debit that is allowed, Sunday debtors, loan to Sri Krishna at the rate 10% per annum, balance on 1st April, cash at bank, bills payable, then sales, then you are having insurance, gas and fuel, bad debts, office rent, freight, loose tools, factory lighting, provision for doubtful debts, interest on loan to Sri Krishna and cash in hand. You see, trial balance is not given here. Only the balances which are extracted from the books are given. Hence, you have to first see whether trial balance is agreed or not. So taking separately for debit items and credit items. Okay, that you have to check first. Then we are having different adjustments. Stock on 31st March was valued at 72,600. A new machine was installed during the year, costing rupees 15,400, but it was not recorded in the books as no payment was made for it. Wages rupees 1,100 paid for its erection have been debited to wages account. Remember, while doing the rectification of errors, I have said, if any wages are paid for erection of plant and machinery, then these wages is to be capitalized. That is to be added with the cost of the asset. You cannot debit to the wages account. Then is given depreciate plant and machinery, furniture and fuel property. Loose tools were valued of the Sunday debtors, rupees 660 are bad and should be written off. Maintain a provision of 5% on debtors for doubtful debts. And the most important item is the manager is entitled to a commission of 10% of the net profits after charging such commission. Okay. So we are going to compile first trading and profit and loss account. So we are having opening stock. Then we are taking purchases. From that, we are going to deduct the returns. Then we are writing two wages. And from there, we are deducting wages for erection of machinery. Then we are taking gas and fuel, freight, factory lighting, and the credit side we are taking sales and closing stock. So next part, we have brought forwarded the cost profit. Then we have taken interest earned, including outstanding, which is not earned but not yet received. So total interest comes to 4,400. Then in the debit of the PL, we're writing two salaries, two office expenses, two postage and telegram, two insurance, to office rent, to discount, to bad debt. Then to provision for doubtful debts, new minus old. Remember, if old provision is more than the new provision, then it will be shown in the credit side, old minus new. But here, new provision is more than the old. That's why you are writing two provision for doubtful debts, new provision less old provision. Then we are writing two depreciation, respectively on machinery, furniture, freehold property, and loose tools. Then we are required to write to commission to manager, and for that, a working note is to be made. And let us come to the working note. Before charging manager's commission, credit minus debit in the PL, the profit is 44,880. Let the profit after charging manager's commission be rupees 100. Commission is payable at the rate 10%, that is rupees 10. Therefore, profit before commission will be 100 plus 10, that is 110. When profit before commission is rupees 110, the commission will be rupees 10. Therefore, when profit before commission is rupees 44,800, then the commission will be 44,800 into 10 by 110. Mind this, 10 by 110, it comes to 4080. That we have taken to commission to manager as per note 1. And finally, your credit is more than the debit. And we have written to net profit transferred to capital account. Now, balance sheet we are going to do as usual. That is plant and machinery. We are considering additions of the new machinery, including the wages that we have deducted from the wages as wages for reduction of machinery. So total comes to 15,400 plus 1,100, that is 16,500. So total including opening balance and addition, it is 1,15,500 less depreciation. Then freehold property less depreciation. office furniture less depreciation, then loose tools less depreciation, then we are having closing stock, then Sunday leaders less new provision 1430. Just have a look. 1430 is the new provision. Okay. Then loan to Sri Krishna, add interest outstanding, then cash at bank, and then cash in hand. And in the liability side, capital at net profit, less drawings, then bills payable, then Sunday creditors, we are having 44,000. Just have a look. Sunday creditors, 44,000. And then you see a new machine was installed during the year, 15,400, but it was not recorded in the books as no payment was made. Hence, your creditors will be increased by 15,400. So 44 is the opening plus 15,400. It comes to 59,400. Then manager commissions that we have calculated, 4080, that is payable. Okay, so balance sheet total comes to 3,25,380. Now we are coming to the next sum. The following is the trial balance of Mr. Mohesh as on 31st December. Prepare a trading and profit and loss account for the year and the balance sheet from it. So as we see, trial balance, debit and credit is tallied, but still you have to check. Then in the adjustment we are having on 1st January 2014, machinery worth rupees 5,000 was sold for 4,000 and credited to machinery account. Wages include rupees 1,000 paid for machinery erection charges. Purchases include cost of moped scooter for rupees 5,000. Proprietor has taken goods costing rupees 1,000 for which no entry has been made. Sunday debtors include 500 which had become bad. Provide 10% provision for bad debts. Electricity outstanding 50, goods costing rupees 5,000 was destroyed by fire, and insurance claim was received for rupees 4,000. Provide depreciation at 10% on machinery, furniture and moped. Provide depreciation at 5% on building, and closing stock is 12,000. So we are going to put into the trading and PL. Opening stock, 2 purchases. It includes cost of moped scooter. That is a capital item deducted. 2 wages, erection of machinery to be added with the machinery, hence deducted. Then buy sales. Then goods destroyed by fire. We have taken 5,000 minus 4,000, that is 1,000. Closing stock. Then by drawings, goods taken by the proprietor. We get the GP. Now we bought forwarded GP. To salary, provident fund amount is to be added. To employer contribution to provident fund. To rent at outstanding, to electricity at outstanding. To commission, to trade expenses, to interest at outstanding interest. Then 2 goods destroyed by fire. 2 bad debts. 2 provision for bad debts. To loss on sale of machinery. Then we are going to charge the depreciation. building, machinery, moped and furniture. Gross profit we have brought forwarded. So net profit will be transferred to the capital account. Now we are coming to the balance sheet. But before that, let us look into the working note. We have total goods destroyed by fire is rupees 5,000. Okay. Insurance claim of rupees 4,000 has already been received and has been properly accounted by debiting cash account and crediting purchase account. Okay. Now adjustment is required for rupees 1,000 only. For adjustments of rupees 1,000, the following entries are to be passed. That is, goods destroyed by fire account debit 1,000 to trading account 1,000. Then profit and loss account debit to goods destroyed by fire account. So, coming to the balance sheet, first let us do the asset. Building less depreciation, machinery and wrongly wages paid to the erection of machinery was taken into wages account, that is adjusted, and wages for erection is to be added with the asset cost. Then there is a loss on sale of machinery deducted. Then we are going to deduct the depreciation. Moped scooter, assuming for business, on which you have deducted the depreciation. Then furniture less depreciation. Closing stock, it is an adjustment entry given separately, not in the trial balance. So closing stock we have taken 12,000. From debtors, we have deducted bad debts. And from good debtors, that is debtors less bad debt, is the remaining good debtors, and on which we have made provision for bad debts, deducted, and debtors comes to 9,000. Okay, then in the liability side, we are having capital account. Then we are adding net profit. Then we are deducting drawings. You see, we have taken 5,000 plus 1,000. You see, goods taken by proprietor 1,000. That is non-cash drawings. That is in the form of goods. So it is to be included in your drawings. And same is credited to the trading account. Okay. And other drawings, that is drawings in the form of cash, that is actually considered. That is, in total drawings, we are having cash drawings plus non-cash. That is goods. So total drawings comes to 6,000. Creditors, we are having 15,000. 10% loan, 10,000. And in outstanding liabilities, we are having interest 100, rent 250, and electricity 50. Okay. So balance sheet total is 84,600, both assets and liabilities. Now we have concluded the final accounts, and I have discussed with you what are the respective items that we are going to consider in trading account in the form of debit and credit, how we are going to make the closing entries in trading account, Then I have discussed how you are going to prepare the profit and loss account and what are the items that will be considered in debit and as well as credit side. Okay. And we have considered the various adjustments. That is, I'm just making the synopsis. We have made the closing entries and how the balance sheet is actually being prepared. That I have also discussed. Okay. And finally, the various adjustments that we are required to consider for preparation of the final accounts in the form of goods distributed as free samples, income tax, then advance tax, then interest on advance tax, if any, then drawings made by the proprietor, then drawings made by the proprietor in cash and also in kinds, then debtors arising out of dishonour of checks or bills, then we have considered abnormal loss of stock by accident, that is by fire, then goods sent on approval basis, then we have discussed interest on loan not yet paid, fully or partly, then interest on capital, then interest on drawings. Then we have said how the closing stock is to be taken into account. That we have discussed. And finally, we have discussed through examples that how trading and profit and loss account is actually being prepared. Now, I have to say something to you for your forthcoming examination. You are provided with the study material. So my advice to you will be to go through the study material thoroughly and go through the examples, including objectives, questions and answers which are provided thoroughly, and prepare yourself and also practice the problems of your own, not looking into the solution. I mean, you have to do it in black and white, that is in writing. So many students, they read, but they don't write, is not going to write, or writing practice is not done by them before examination. Okay, so I request you to do the problems and solutions in writing also, so that you have to check that whether you are in a position to do it correctly or not. Okay, so again, I am just going to remind you, please go ahead with the study materials and read the study materials thoroughly and try to understand the meaning, solve practical problems. Okay, hope you can come with flying color in the examination. With that, I just say goodbye and I finish the class for the day. Thank you very much.
Thank you, sir.
Welcome.